Alright guys, so now we are delving into the course. So we're starting with Introduction to Price Action Trading Strategy, the Advanced Support and Resistance Strategy. Alright, so imagine the financial market. Let's consider the scenario. Imagine the financial market as a battlefield because it is really is. It really is a battlefield. A battle between buyers and sellers, between bulls and bears continuously fight for dominance. The buyers side say, oh, this market is going bullish. The sellers are saying, no, this market is going bearish. And then the market will just be ranging, as the case may be. They are constantly fighting for dominance. And you know why? Because who are the participants of this market? They are rational beings. They are human beings. Even you are human beings. There's most of the time you see a market and you prefer to buy the market, but you don't forget that the reason why you are deciding to buy the market, another trader might be deciding to sell the market, right? And another trader might even have a limit order, and which is his or her entry might be your stop loss, right? So you can have such stuff like that. So all of these are what influences the market. And in each case, if the buyers are in control, the buyers supersede the sellers, the market will go bullish, and if the sellers supersede the buyers, the market will go bearish. Yeah. So in this battle, support and resistance levels act like strongholds. Can you okay? Try to relate with this now. The mark as they act like strongholds, zones where price historically react. So historically, past data, zones where price historically react, either reversing or consolidating before making its next move. Support is like a safety net. It's where price tend to stop falling and bounce back up because buyers step in. So think of it like this. I am you are standing from where you are now, or your feet is at a base. So what is that base? It's a support. It is supporting you. It is supporting your weight, right? So that is support. So in terms of price now, price will always come to a point where there will be a base for it. That is a kind of zone, and market will just for some reason it cannot break that zone. It's just like a magnet, like a like force. They are like forces together, positive and positive. They cannot attract each other, either they will keep repelling. So that's like a support. It keeps floating. It's a safety net. It's where price tend to stop falling and bounce back up because buyers step in. And as well, resistance on the other hand is like a ceiling. Yes. So this time is ceiling. There are different types of ceiling. Like the normal one that most people know, that way you can just use your hand and just do like this to break. But a ceiling, a tough ceiling that is like a cement. It's like a wall. That's like kind of resistance. Well, yeah, it's a kind of ceiling because most time price do break those ceilings. Alright, so it's where price struggle to move higher as sellers push it down. So price is trying to move higher, sellers are trying to push it down. So eventually the resistance is obstructing the price to move higher. So that is a resistance. And most times there are zones. Yes, there are zones of interest. Alright, so mastering advanced support and resistance strategy means going beyond the basics. It's about understanding how liquidity, market structure, and institutional order flow influence price reaction at these key levels. So take note, those your support and resistance zones, they occur at key levels. Take note. So banks and hedge funds don't use simple horizontal lines like most retail traders. Most of the times everything that just look very simple and basic, they'll say is retail traders. They say retail stop loss, retail. So what if a retail trader is trading like an institutional trader? But they'll say stop loss hunt is retail traders. But it is what it is. Yeah. So how liquidity, market structure, and international order flow influence price reaction at these key levels. Bank and hedge fund don't use simple horizontal lines. They look for zones where liquidity is trapped, manipulating price before making big moves. So in this section, we will explore how to properly identify and trade support and resistance zones, including key strategies that align with institutional trading concept. You will learn how to: number one, identify true support and resistance levels beyond simple horizontal lines. Number two, use supply and demand zones to spot high probability trade setups. Number three, combine price action signal like wicks, engulfing patterns and liquidity graph for confirmation. So this is what we talk about our conferences. Yeah. And again, understand fake breakout, stop loss hunt, and how institutions manipulate retail traders. Alright, so let's delve deep into the course now. And as well, we'll look at each of these, more uniquely, yes, more uniquely with practical examples from the chart. Alright, so with this insight, you will refine your trading edge and gain confidence in executing trade based purely on market structure and price action dynamics. So let's delve deep. Alright. So advanced support and resistance strategy, identifying key levels and trading techniques. So to effectively trade using support and resistance, it is crucial to identify high probability levels, not just any levels, but high probability levels where price is likely to react. Many traders rely on drawing simple horizontal lines, but professionals understand that the market moves based on liquidity. Yes, the market is a mechanical system. It will move based on liquidity. Liquidity is like the fuel that fuel the market, right? Yes. Order flow and institutional activities. Yes, that is high demand and supply. All of those influences that moves the market. So identifying key support and resistance zone instead of using single lines. Focus on the zones where price has repeatedly react. Here is how to find them. Number one, we have historical price reaction. What do you mean by historical price reaction? There are areas of interest like swing highs and lows, past resistance and support breakout level. Areas where price has previously reversed multiple times. Calm down, take it gradually. Historical price reaction. Areas of interest like swing highs and lows, past resistance and support breakout levels. Areas where price has previously reversed multiple times. So first, swing highs and swing lows. You know what swing highs means? You know what swing lows are, right? Yes, and as well past resistance and support breakout level. So this support now broken. You are looking at those level that was broken. Very importantly, there are key zones, and as well um, areas where price has previously reversed multiple times. Alright, let's look at this now. Okay, just looking at this image now, you can see this is the daily time frame GBP USA. So you can see that from here there was a rejection at this point, and as well at this point there was a rejection. At this point there was what, a rejection. At this same point there was a rejection. So what can you see now? You can see that here is what, here tends to be a resistance for this price, and as well here is a resistance for this price. Why? Because price failed to break it. You see, it just came with weak. And as well here is a support for this prices. It came with weak. Here support, it came with weak. It never broke with body break, right? Then what happened? Price rallied down and then boom. Then what do you call this now? You call this a breakout. This is the breakout because what, price has finally broken out from this zone, from this key level. Yes, so what do we have here? See, areas where price has previously reversed multiple times. One, two, that's reversed. So this is what now? This is a support. This is what now? This is resistance. So breakout, okay, and support breakout levels, swing highs and swing low, past resistance and support breakout levels. So now this is a kind of swing high. So now what is this? pass bro- um, um okay, past resistance and support. This is past resistance and support. Breakout level. So this is the breakout level. This level now with this red line. So what happened now? It's a zone. You can see that price still came back and tap here as a confirmed support. This was a resistance, it was broken. It is now a support. Price tap on this now, and you see it who held it to the upside, right? So historical price reaction. This is historical price reaction. Swing highs and low, past resistance and support breakout levels. Areas where price has previously reversed multiple times. Yes. So you can see the same in this chart. So here a breakout, this zone was tested now as a resistance, was a support, it was broken, now it's a resistance. So here is a support, here was broken, and here is what now, a resistance. Here is support, broken, a resistance. So you see resistance, you see support, support, support. So support is down, resistance is up. Alright, the same for this as well. This zone, you see, and boom, it's setting down. Alright, so the next one is what? The next um key element of interest is the psychological levels. So we are talking about key levels now, we are talking about zones and areas of interest where price will likely react from. And now we are considering key levels. Okay, we are considering, sorry, psychological levels, which we tag as round numbers. So what is psychological levels? They are institutional traders. Okay, institutional traders often place orders at whole numbers like this or this. So take note of this now. Please take note of this. You see these round numbers like 0.0000 or 0.50, 0.500, 1, 2, all those round number 2.00, 1.00, they are what, they are psychological levels. Okay, now look at this image. So if you look at this now, you see what is it? This is 165. Is what? 165. 165 point what? Point 500. So this is what? This is a key level. Take note. So this other one is what again? This one is 161.500. So what is this, a key level? So notice price reacted, reacted, resistance, reacted, resistance. See this small retest support. It went up now to this other one, reacted down. Then this was not a kind of breakout, you see, because it was weeks. And then it reacted at this other one again, 500, and then it went up to this one. You can see the price is just ranging around this key level. So maybe from this point, if you can catch your trade there, you are out of here. And maybe if you cut it this trade for buys, you're out of here, and you see it just makes sense. Or if you sold this trade, you're out of here, so you're out of here, you get the point. Yeah, so, and you can see the reaction. So this is what we call psychological levels. So institution and our traders, they love buying at psychological levels, like they love buying at psychological levels. So we too, we can trade like institutional traders, and also get to flow with a big move. Yeah. So the next one is what? Liquidity pool. So what can we refer to as liquidity pool? Liquidity pool, the market is being influenced by liquidity, and liquidity can be seen as the amount of orders in a particular region. That is the amount of active trade transaction. You get the point. So the amount of active trade transaction of participants in that market is what we call liquidity. So if traders are buying a particular asset well, and the majority of the traders are buying the asset, what will happen to the asset? The asset will be buying. Why? Because there is liquidity and there is demand for that asset, right? It will be buying. And then, just in case, let's say that was okay, there was a market reaction, there was a breakout from the zone, and then market came and retest, and that retest, what will happen in the lower time frame is going to be a break of structure, a market structure shift coming down. And as well, now you are in that trade, you forgot that that was a counter trend trading, that we are supposed to be buying after the retest instead of selling. and then you're just in the market, just observing, and then boom, just the market just start rallying up. But then you notice that what the market do, market since that market was selling, most traders they might have forgotten about the overall structure of the market, and they might just sell maybe for some greedy kind of TPs like that. So at those points now, market needs to market will rally away their stop losses, and it will make sense because in a market, in a balanced market system, there's supposed to be 50% buying and 50% selling, right? So for every sell order, there's supposed to be corresponding buy order, but that we don't know how that is being done, because the market, where you just collect your order, your broker fills your order for you, and you just send the order to the direct liquidity pool. So at this point now, your stop loss is a liquidity. So just imagine, let me just say most retail traders, because this analogy is usually sweet on retail traders, you know they are just entering a position. Okay, let's consider this structure. So in this structure now, you can see sell stop. Why is sell stop? Because people are breakout traders are trying to buy this market from this point, and this is a breakout they're trying to buy. So sell stop order is here. Okay, sorry, their stop loss, people that are selling this market, their stop loss are at this point. So what are they expecting? They're expecting the market will just keep dropping down, but market came up. And as well, breaker traders, they're expecting to buy this market, and then what happened? Market came up now up to this point, and then it now dropped again. This is a high. All these people now that enter this trade, their stop loss will be above here now. You get the point. So now when this market rally like this now, that's taking their stop loss, and people now that enter this trade, their stop loss is still here as well. So what now happened here? Market now came here. So this is what now all of these points now that people are entering their orders, if they should liquidate their order. Okay, this is it now. You enter a market for buy, you are buying the market. For you to close that position, do you know you are automatically selling that position, because you are buying the position. For you to close the position, you have sold the position. That is it. That's what we do in trading. And if you are selling a position, for you to close out position, you automatically buy back the position. You get the point. So for traders that are selling this market here, if their stops should get triggered, that means they have automatically bought the market. And now for other traders that want to sell, they need that kind of buying. They need some people to buy the market, so that they can now sell the market. I don't know if you get the point. So it will be as if it's a kind of balance reaction. People are selling and this other ones are buying. So that's why they will rally the stop loss to this zone, and they'll take or clear all the stop loss, and then they'll run drop. So this is one now they call this one, call it what, liquidity pool. There's liquidity pool, they call it stop loss hunt, and then boom, market now drive down. You get the point? Yeah, so we call stop loss hunt. So liquidity pool. Yes, so you can say that is a good is a good is a good resistance zone that price will always react from, right? Yes. So this is one of the zones you should take note of. All right. So the next one is what? Trading techniques for support and resistance. So what are the trading techniques for support and resistance? Take note of this now. We are talking about support and resistance. We are talking about zones. We are talking about the zones of interest, critical zones, right? Yes. So in this case, when we are talking about zones, we also consider breakout, right? So this know now that when a zone is being broken, there is most times or logically market will always come back and retest the zone that was being broken, and then we call that retest or pullback or retracement, right? And it makes sense. So now when price breaks a key level, you wait for a retest before entering a trade, because you don't want to just buy from the premium. Okay, sorry, you don't want to just buy from the premium, rather you want to buy from the discount, right? Yes, so that you can buy cheap. Yes, so that is just the motive. So you allow market to retest before buying. You don't just want to just buy, except maybe your strategy aligns with that, right? Yes. So the next one is what? Confirmation comes from price action signal like bullish, bearish, engulfing. Okay, this one is further entry trading techniques for support and resistance. So this is how the diagram looks like. So now this is a resistance zone, previous resistance. Market was unable to break this, it came down. Rally, and then it came down to this point, and then boom, there was finally a breakout. So what do you do now at this point? You wait for retest. And where is the retest? This is the retest at this zone. Right, yes, this is the retest. So market retest, and now what? You are waiting for your confirmation price action signal like this. Your confluence is to be met, and then you are trying to catch the trade up again. Continuation, right? Yes. So this is what the breakout and retest strategy. So this vice versa. If you turn this, flip this down, the same thing. When a market breaks to the downside, you're waiting for retest again to sell it as well. Yeah. So you can see, yes, this is what break to the upside. Market break this structure, this support, and then he retest it, and then it is heading up. And then market broke this down, a retesting, and then what will happen? It will be heading down. Support levels becomes new resistance. Resistance level becomes new support for market to go up, new resistance for market to go down, depending on if it's a bullish or bearish market. So the next one is this also entry mode as well. Remember when we were talking about stop loss hunt? So it was under the key levels. It was on key levels that we make reference to. So now we are talking about entry model again, and we are saying that liquidity grab and stop hunt strategy, right? Smart money often push price beyond a key level to trap retail traders. So they will now move price in the first direction as if they want to buy. Meanwhile, they want to sell, then they will just start dumping the market. Or they want to buy, they will now move price as if they want to sell, and then they will just start buying everything. So they move price beyond a key level to trap retail traders. If price breaks support but quickly reverses with strong momentum, it's a stop hunt. Enter in the opposite direction. Alright, so this is a hint. So now this is a support, right? Okay, sorry, this is a resistance level. This is equal tops. So this is liquidity, because people try to sell this market, say their stop loss was above, sell their stop loss was above, sell their stop loss was above. And so when you see this now, what are you concerned about? You want to see a sweep of this liquidity, and this is how you know that it's a sweep. You reject maybe price the candlestick that break the zone. It did not break it with the body break, and then it rejects back. So that means you just see the wick, or it breaks and then you just see one candle, maybe a red candle, and the red candle just engulfs the candle, or maybe the consolidating area very bad. Then you know that that was a kind of rate of liquidity. Why? Because there were passive orders at that zone, and then as market just filled all of this, the institution, they just took the market, and the market just start dumping. So this is an entry model, right? Yes, it's an entry model. And that's okay. Yes, so this is it. You see this is a kind of breakout. You see this is a breakout, and they see this engulfing. It engulf one, two, three, four candles. So you just know that some market is about to do something fishy, and you can even catch this for yourself if not to position yourself. Because normally, if you want to buy this market, you know how a retest is supposed to be. It's just retest and you get confirmation of some candle. But now instead of it to retest with some rejection, it is coming down engulfingly. So you just avoid this. So liquidity hunt, you sell, is an entry model. So the next one is what? Supply and demand zone. So supply and demand zone often align with, okay, a support zone, sorry, often align with demand zones where large buy orders are placed. So at support zone, you know, it aligns most times, but not all the times, with demand zones, and as well resistance zone coincide with supply zone where institutional offloads position. So at those key levels, there's been stack up of position, and then either in a demand zone, okay, in a demand zone, market will just start buying after market tap into the zone, and as well in a supply zone, market will start selling. That the supply of that currency is high and the demand of that currency is high. What will happen? The market will buy. If the supply is high, the market will drop because the demand will be low. Yes. Alright, so these are zone of interest. These are supply zone. You can see the zone of consolidation before the impulse move. So this is supply zone. So sometimes the zone that the last candle before the impulse move and that created an imbalance. So this is a supply zone. You can also call it order block. Yeah. So and as well, this one again, the last candle before the impulse supply zone. So market tapped on this and what? Boom, it head down. So this is a supply zone, as I see. Market tapped on this and it rejected at this point. But this is in the higher time frame. This one held well, and here this is the demand zone again as well. So market tapped on this, it ranged there, and at this now it was stop loss hunt, and boom, it started heading upward. So maybe for me again, we still get another reaction in the future. So you can just see demand zone. See as market is just reacting meticulously to all of these zone. So you can use them as entry. On supply and demand zone, they are the most high probability risk to reward entry. Yes. Okay, so this technique provides a trading edge, ensuring you trade with smart money instead of against it. Alright, so the goal is to trade alongside the institutional traders, that is the big boys. So when you trade with supply and demand, you are unconsciously, meticulously trading with the smart money, that is with the big guys, and that is what you want to trade, because that's how you make your money. Alright, so the next curriculum is what? Chart patterns. So what is chart patterns? A roadmap to market structure. So chart patterns is market structure in obsolete order forms. Just get the point. It's market structure that we know in order flow, that we have bullish, bearish, and a ranging market. Chart patterns is order flow and obsolete structure. Alright, so this is what I mean. Market structure tells you the flow, the direction of the market, and as well chart patterns can also mimic the flow of the direction of market, because in the market there are some patterns that they form support, right? If I start mentioning them now, okay, let's just follow the course itself. Alright, so chart patterns are essential tools for traders, providing insight into market psychology and potential price movement. These patterns form due to repeated human behavior. Like I said, it is always human that influence all of these patterns and institutional order flow. Yeah. So making them high probability trading setup when identified correctly. So we have different types of chart patterns. Like I said, chart patterns, it is a mimicking of good resistance and support either. The market tends to react more well. You get the point? Yes. So now the first we have reversal chart patterns. So what are reversal chart patterns? These patterns signal a potential change in trend. So the market was bullish, a reversal chart pattern would signal that the market want to start going bearish, right? Yes. So examples of a reversal chart pattern is what? Head and shoulder. So head and shoulder is what? Is head and shoulder, sorry, signals a bearish reversal from an uptrend. Take note, head and shoulder signals a bearish reversal from an uptrend. So as well we have head and shoulder, we also have inverse head and shoulder. What is inverse head and shoulder? Is a bullish reversal pattern forming at the end of a downtrend. So at the downtrend market want to change and start buying, we might likely get an inverse head and shoulder. And from the uptrend market want to change and start selling, we might likely get what? A head and shoulder pattern. And please note, this is just a theoretical aspect. So we'll go into the chart work very soon and we'll exploit some of these stuffs there as well. Yeah. So the next pattern is what? The double top and double bottom. So price test a level twice. When price test a level twice, falling to break through. It tests the first time, it tests the second time, and it does not, it cannot break through. There is no momentum to break through. is indicating what? A reversal. Alright, so let's first of all see head and shoulder. So this is what? Head and shoulder and inverse head and shoulder. So see head and shoulder. This is what? Head. This is shoulder. And this one thing you know, they will not always look as clear as maybe when you just use your flow path and just draw it. No, but you are the one you to mimic this, like not like mimicking sha, but you are the one to look at the chart and try to figure it out, is whether it's head and shoulder or inverse head and shoulder, right? Yes. So at this point you can see this is a left shoulder, right shoulder, this is the head. Market failed to go above it, so head and shoulder. So this one is inverse head and shoulder. So what can you see? This is the head, and this one shoulder, shoulder. So now you see that this one is slanting. It's even telling you that market is about changing structure, because you can see that this is break of structure and the market came to this point. Now sef, this one was low, this one was low, and okay, this one was high a little bit, and this one was higher. You get the point. So you see that there is good momentum to buy. So this is how the structure looks like. Yes, head and shoulder, 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 head. So head and shoulder, okay, inverse head and shoulder indicates what? A bullish reversal, while head and shoulder indicates a bearish reversal. Alright, so this one is double top and double bottom. So what is this now? This is what? Double bottom. When market come to this point one, come back again and come to this point and fails to break it. What do you say? You say you have double top, okay, double bottom, sorry. And now neckline is a point of interest for you to watch out for, right? Yes. So sorry for the interruption. So, and as well, the double top, you have a high and then a second high, and then price fails to break it above. So what are you expecting the market to drop? And now if you can get this confirmation neckline break, it's telling you that there is more bearish momentum in the market as well. So this is what now, this is reversal chart pattern. Market was buying, was supposed to retest and break structure and continue buying, but it stopped from double top. Market is going down. Market was selling, supposed to continue selling, but then it stopped, it broke out. So all of them. So now this is example in the chart. Now this is what? First, second top, and then this was not a breakout. It's not a breakout, it's wicks. So all these wicks now you can call it, is a double top, and then this is the neckline, and it was broken, and you can even see retest. So it's a kind of entry model. You enter and then you're targeting any area of interest cross buy. Alright, we are flowing. So the next one is what? The continuation chart patterns. So what is the continuation chart patterns? These patterns indicate that the trend is likely to continue, right? Yes, indicates that the trend is likely to continue. Flags and pennant, they are okay. We have different parts of this. So this one is a continuation patterns, right? It show you continuation in the market movement. So if the market is buying, it show you, it giving you a signal that okay, this market will still continue buying from this point. The market is selling, it gives you a confirmation that this market somehow will continue selling from this point, right? So that's what continuation means. So this pattern indicates that the trend is likely to continue, as simple as that. So first we have flag and pennant. Small consolidation after strong moves, ideal for trend continuation trade. So now this is flag and pennant. You can see flags. The different types of flag. We have bullish flag. So you see this is a flag. And you wait for breakout here buying. So this is one a bullish wedge flag. It's a wedge pattern, but it's a bullish one because market is this, we can call this retest, because after breaking it to continue buying. So this again for a bullish pennant. So you can see this at this zone, market breakout, it will continue buying. So if you flip all of this, you have the opposite of this. And now if market breaks out to the other opposite side, you join it. So it's as simple as that. This one is what? Ascending and descending triangles. Price coils within a narrowing range, preparing for a breakout. The next one is what? Wedges rising and falling indicate a weakening trend, often leading for a breakout. Let's see the image. So this one is what flag and pennant. Okay, example of flag and pennant as well from the real chart view. Yeah. So this one is what ascending and descending triangles. So you can see this triangle is ascending, support rising. You see resistance lowering. The resistance is what is being respected. That consequently you're having lower highs. So this is what descending triangles. But here consequently you are having what higher highs. Yeah, so that is how to depict them. Alright, so this one is what? What's the falling and rising wedge pattern? So this is wedge pattern. This uptrend, this downtrend, this uptrend, this downtrend. As the case may be. This what now? This is a falling wedge pattern. It has fallen. It went into this state, it break to continue fall. You get the point? Yeah, so this one is for uptrend. It was buying, it went into this state, and if it breaks up to continue buying. It's as simple as that. So number 3 is what? Trading chart patterns with confluences. Alright, you know what confluences is, guys. Confluence gives you a reason to enter a trade. And for you to take a trade, you need to have multiple confluences. Not just one, not just two. Maybe you might have from 3 upwards, as the case may be. But you have to make your technical trading simple so that you can execute your trade as soon as you get confirmation, right? So you're not just being very complex like that. Right, so to maximize accuracy, combine chart patterns with key support and resistance levels. So now we are adding chart patterns with key support and resistance levels, and as well what again with liquidity graph and stop loss hot, and as well the last one is candlestick confirmation, right? Rejection, wicks, engulfing patterns, very important for us to have high precision trade. Yes. So confluence trading, you can go and see this one. So when you see this, you might screenshot it and then you can look at it. So this indicator, this confluence trading chart patterns, see all these chart patterns that we just spoke of. Candlesticks now, you see this, but then we'll talk about candlestick more precisely in the next chapter. Alright, so practical breakdown of the candlestick. So now we are into the candlestick. Mind you, please, there will be each section for all of this. The Japanese candlesticks, chart patterns, yes, and support and resistance. There will be personalized videos for that, but this is just an overall video insight because this is mainly technical analysis, right? Yeah, so head knowledge is too much these days. We need to practicalize it, but then you have to go through this to have the knowledge basic. Yeah. Alright, so practical breakdown of the Japanese candlesticks. So Japanese candles patterns provide insight into market sentiment. So this will help us with directional bias, which we call market sentiments, momentum and potential reversal. Professional traders use them in combination with support and resistance, liquidity zones and order flow for high probability trade. So for what? High probability trade, very important. So understanding candlestick structure. So first when we look at the candlestick, each candlestick represents a specific time period and consists of a open, the price at which the start of the time frame, a close, price at the end of the time frame, that is at the end of that candle, where that candle close. Then the high, the highest point that price reach during that time. If this is 1 hour candle, the highest point the 1 hour candle reach. This 4 hours candle, the high, lowest point the 4 hour candle reach, the low. Then the weak shadow represent price rejection. Yes, like this now, price rejected this buys, price rejected this sells, right here. So a bullish candle green or white means price close higher than it open. So a bullish candle is giving you what a buying bias, that price close higher than it is open. So price open here and it close up, and then a bearish candle is giving you a selling bias, price open up and it's closing down. So take note of that as well. So key candlestick patterns and their meaning. We don't need to have all the candlestick patterns to make things complicated for you. Rather, We just have some that we know that they are very important that you need to know and work on and be using. Yeah. So the second one is what is hammer and inverted hammer. So what does hammer indicate in the market? Indicate rejection of lower prices in a downtrend. So now, and it gives us a bullish. So this is a downtrend, indicate the rejection of prices in the downtrend, and gives us the indication of what? Of a downtrend that is bullish signal. Yeah. So you can see example. So the next one is what? Shooting star and hanging man. So what is the work of a shooting star and hanging man? Show rejection of higher price in an uptrend. So now this is what shooting star, it is shooting, and hanging man, this is hanging man, shooting star. So what does it does? It show rejection of higher prices in an uptrend. Price rejected of the uptrend. Get the point? Yes. So this is shooting star, this is hanging man. Take note. When we add building our conferences together, we might add most of this as well for our checklist. So the next one is what? Doji candle. So doji candle is an indecisive candle. So you don't want to be trading the doji candle. So maybe if the 1 week is having the doji candle, you can just wait first until you get good confirmation, good momentum. You get a point before you can trade. So doji candle is indecision. You don't know what to do. You don't know whether to buy or to sell because there's nothing instant. There's nothing, no bias, clear bias is going in the market. So it's a moment to pause. Okay, it's a pause in momentum and often before a reversal continuation continues. Okay, the next one is for pin bar candle. So this is the difference between pin bar and shooting star. Pin bar is very long wick rejection, but shooting star can be small wick right here. So this is a pin bar. It's a candlestick pattern that signifies a potential price reversal. Like this is one of the good candlestick confirmation for price reversal. So you can see that it rejected this price. You know that, oh, somebody want to buy. It rejected this price. You know, somehow the peers are taking control of the market. So this is how you use it. But not every time you see a pin back candle that you say you want to buy, no. And not every time that you see a pin bar bearish candle, a bearish pin bar that you say you want to sell, no. So you need to add with other words conferences. Thank you. So the next one is what? Inside bar. I love this one. Please pay attention. What is the inside bar? The inside bar is a candlestick pattern where a candle's range higher, okay, sorry, high to low is entirely contained within the range of the preceding candle, often signaling a period of consolidation or indecision before a potential breakout or continuation of a trend. So notice now, there will be a consolidation within a particular candle time frame, and then a breakout. That breakout is not a breakout in the zone necessarily, but it's just a breakout of candlesticks highs or lows as the case may be. So now you can look at this now. Since candle it was trying to buy but it was consolidating. This is what now? This is engulfing. This red candle has engulfed it. So here this green candle has engulfed it. Okay, so looking at this now, what can I say? I can say that okay, this is okay. After this is a kind of order block. So this is what now? After this consolidation, we had this inside bar breakout, right? Yeah, so we have this inside bar breakout. This was the bars inside. This is the inside bar and this was the breakout. So this is the inside bar, this day, and this day breakout, right? So take note of this as well. So when you are trading, when you see this kind of setup, you want to buy a market and you see inside bars, you know that okay, it's a good confirmation to your trade. Like this, if you see this one, it's a good confirmation to buy. This one now, okay, there's no bearish one like that. You know, like good confirmation to sell. All right, so now I come to this one, this last one. We call it bullish and bearish engulfing. I love this one because I use this in trading as well. Remember when we were talking about stop loss hunt, we're talking about engulfing. Okay, no, No, but we're talking something close to that. And we're talking about engulfing. Okay, yes. So, in a bullish and bearish engulfing, a strong shift in momentum where one candle completely engulfs the previous. So, this is what this is a red candle, and then you just see buying buyers. He started buying, and this one engulfs this one all within. So this one bullish engulfing. The same way see a green candle, and then it might not necessarily be a green candle, but green candle and engulfs with a bearish candle, it makes sense, telling you that the momentum is somehow shifting. So you can see this is inside this candle. So what's the difference between this bullish and bearish engulfing and inside bars? In inside bars you have more than one candle, but in engulfing, you might still have more than one candle, but inside bar is a kind of breakout from that zone, from that candle. Okay, that candle should break out from that kind of zone. But engulfing, you just need to engulf the particular candle, close below the wick or the body, or above the wick or the body, and that is what we call what engulfing. So trading candlestick pattern effectively. So pay attention to this now. Use candlestick confirmation at key levels alone, support, resistance, supply and demand zone. Yes. So you know that you just want to take a trade. Your candlestick, you see any candlestick reaction, you take a trade. No. But when you add those conferences to your key level support and resistance, maybe there is support, I know that it will hold price to go up. You add all of this confirmation, maybe you know add all of this confirmation, so maybe everything meet up and then boom, yeah, in your trade. So the next one is what, look for liquidity grab. We talked about liquidity grab, stop loss hunt, and then before candle confirmation. Okay, before candle, strong candle confirmation to avoid false signals. Like we're talking about bearish engulfing after liquidity grab. Pay attention to all of that. So now combine with other conferences. Okay, like moving average, trend line, and volume. But you can ignore moving average because we have not talked about indicators, so you don't need to overload the chart. So maybe as you progress further, in other section of this particular curriculum, you come to know how to combine it with other conferences as well. All right, so candlestick tells a story of price movement. Understanding them, allows traders to anticipate market direction with what? With precision. All right, so this is for candlestick. And then we move over to the last curriculum, which is what? Overall support and resistance entry model. So now in this strategy, the strategy is all about the entry model, right? Because we want to know how to buy, we want to know how to sell using a strategy. Alright, so support and resistance is a core concept in price action trading, helping traders identify high probability trade entries. This level act as psychological zones where price historically react, either reversing or breaking through. So types of support and resistance entry model. We have the basic reversal entry. We have spoken about reversal. So now these are the reversal entry. So what are the reversal entry? Number one, we have support bounce. When you see a support bounce with other conferences met, what is a buy entry signal? Enter when price rejects support with confirmation, maybe like bullish engulfing or hammer. It makes sense too much. So you wait for the market to come to your support zone, and then you wait for it to retest. Then you now do what? You now wait for other candlestick confirmation like engulfing or hammer. That is what a reversal entry one. So the two is what is resistance bounce. The same you are doing support bounce. So this is what this support bounce. So maybe if a candle should engulf this trend, okay, you're buying, and then your stop loss is below, and then you're targeting something up. So resistance bounce is the same. So now this is what this okay, this is a trend line resistance in this case. So you bounce off, and then you're trying to sell, but maybe after it engulfs this candle at this point, then your stop loss above the trend, right? So that if you go again, you know that okay, this market is, you are wrong in this position, right? And you accept it. So this is a practical diagram for that. Support bounce, you enter after engulf, or shooting star, as the case may be. This one now, the resistance is shooting star, while support is what? Is hammer. Take note. So now the next one is what? Breakout entry. So enter after price breakout through a strong support or resistance level with momentum. Alright, so the reason for all these multiple entries is because most times some pair has different price reaction. Most times some pairs when they break out they have almost zero retracement or low probability retracement in a high level of trade setup, right? So those kind of trade you can just adapt the strategy that after it breaks out, you just enter and sell it at once. Bam, breakout from that, so you just say sell. You put your lot and you put your SL in a zone like this, and then you're riding it. You see, it makes sense. So breakout entry, you are the one to know the entry now to apply your own system. So the next entry is what? A retest entry. We spoke of retest. We have spoken of retest so many times. So after this break and retest during an uptrend, so this is an uptrend, buy, retrace, buy, retrace, buy. So now this is what again? Break of structure, this higher high. So now if you retested this zone, right? So what will you do? You buy from this zone. So this is what? Break and retest. Trend. Yes. So the next one is liquidity gap. Liquidity gap entries. If you have spoken of liquidity gap, stop loss hunt. So where you see something like this, a consolidation, and then you see this kind of fake out, it's more like maybe the kind of markup. So after this fake out, maybe a spring or liquidity hunt, what did you wait for? Breakout of this zone. This is a reversal now. So break of this zone after this fake out, then you tap to the retest and then you're taking it down, and see that it makes sense, you just drop all the way down, right? Yes. So the next one is what? Stop hunt. Okay, this one is fake reversal. Sorry, fake reversal. See, fake reversal. This one is what? Stop hunt entries. So this is stop hunt where you see weak. They use weak and they weak the price. So price sweeps liquidity above resistance or below support before moving in the redirection. So look at this now. Once the required liquidity are collected, sorry, so don't mind this, right? It's not that complete. It's not that correct. So large move come. Okay, large move came. So this now after this large move came. So now great panic buying move moving against entry. So see, people, this was a kind of breakout. So what do we call this now? Stop loss hunt. Kind of breakout where was a stop loss. He ran through all of their SLs and they start dropping massively. So sometimes it's painful, but then you just have to understand the system and know how to flow with it and choose that which is less painful to you, right? And you just accept the loss and try to, if you can, just in case you had it result in a loss, because not all the trade will go well, then just accept it and just keep up the routine, because not one trade will make you rich and not one trade can make you poor, except you define the possibilities, right? Yeah. So now wrapping it up, it's a trading confirmation for high pro probability entries. Number one, candlestick confirmation. Use price action signal like engulfing pattern pinned by doji. Remember, we have spoke on this. So the next one is what? Multiple conferences. Don't just use one or two conferences. Use three and above, right, for precision trading. Yes, it makes sense. So this one is what? Combine with trend line multiple time frame. Yes, the power of multiple time frame. We'll have a video for that soon. So do well to know how to use your strategy on multiple time frame and to use multiple time frame to validate it, but not all the time frame, please, so that to make it easy and less stressful for you so that you can manage. Yes. The next one is what? Risk to reward ratio. Always ensure a risk to reward ratio at least 1:2.5. I love 1:2.5. Almost like one, yes, 1:2.5 to 1:3. It makes sense so that you can survive the long run even in a losing streak, right? Yes, makes sense. So, and what again? A strong support and resistance entry model minimizes risks and maximizes reward, giving traders a structured way to capitalize on market movement. So you know This strong support and resistance entry model minimizes risks and maximizes reward, giving traders a structured way to capitalize on market movement. So with this we have come to the end of the strategy, but like I said, this is just an introduction. We would have a video for each of them, for the candlestick chart pattern, for the support and resistance, for the entry models, right? Yes, so do want to have to keep in touch with all of this you have learned, so that when we doing a application, you just flow along as well. So now the last thing we're touching is what? Back test. Back testing. So now in quote, back testing price action trading strategy. So take note. Back testing, what is back testing? Is the process of testing a trading strategy on historical price data. To do what? To evaluate its effectiveness before using it in live market. You know, you might learn, okay, the main strategy. You might just learn a strategy and then you're just eager to use it to make money. But then you don't know that you have to test it. And why do you test it? To know the probability of the strategy, to know how to think in probability and to know how the strategy will work, and to know the profitability of the strategy, to give you confidence how you can modify it, how you can be profitable with it, right? Yes, that is why you backtest. And when you backtest, it gives you confidence, okay, this is your setup. And when your confidence is being posted like that, that is what you need most times in trading. So you need to backtest. So why backtest price action strategy? Number one, validate the strategy, because validate the strategy performance helps you see if your approach works over time. So this is it. All assets are not the same. Maybe it might work for a commodity asset, but then in a currency pair asset it will not work. So that is why it is good to know the validity of the strategy in that particular asset. Yes. So the other one is what? Identify strength and weakness in the strategy. So it shows where your strategy performs best or fail, right? So where your strategy performs best. Okay, that some people can call it high probability setup, but in trading you just have to be neutral. You get the point? To maintain a good static risk management plan for the moment, until you attain some kind of good achievement. Yes. So it helps you identify strength and weakness. So when your strategy performs best or fail. So the next one is what? Improves trade execution. Yes, it improves your trade execution. Because the way you have backtested over time, at some point you just see the trade, you say no, this trade, I know that this trade go well, like it's aligned and the confidence is there. Why? Because you have backtested and you have seen that happen repeatedly and the outcome is predictable. So what? It enhance confidence in following the strategy rules. So how to backtest a price action strategy? To pay attention to this now. Choose a trading platform for backtesting. I recommend TradingView. You can get the premium version so that you can use the lower time frame as well. Yes. So, but you can check out on Forex Tester 5 or MT5 or MT5 Strategy Tester. It allows automated testing using expert advisors. This is ES, so you can just be with TradingView. Or as well, check out the Traders Casa. That one is from me now to you as a bonus. Yes. So, but you can forget about this for okay and stay with trading. Alright, so like I commented here, you can just stay with trading view, forget about these ones and just stay with trading view. So the next one is what? Define your backtesting parameters. So before starting, set clear rules. Trading strategy, what setup are you testing? So first of all, you learn about the strategy. The more you learn about the strategy, then you then go to testing. And when you're testing, okay, this strategy is a breakout retest strategy, or this strategy is a breakout strategy, or as we say, or this strategy is a neckline break strategy. As the case may be, maybe with different confirmation entry and your confluences together. So what setup are you testing? Example, support, resistance, candlestick, breakout, as the case may be, you need to figure that. And as well, time frame. what time frame are you testing? Is it a 1 day, 4 hour, daily chart? Depending on the kind of trader you are, they do well to put that into consideration as well. And again, the pair, the market pair, very important. Which of the pair are you testing? Like zero USD, GBP, JPY? Because most pair, like I said, as most currency pairs will not be able to seem like stock assets. So you just need to know what you are doing. Maybe when you test and you see that this strategy works effectively in this asset, then you know that okay, that asset is, you might consider trading that asset for a while you still do your research in it, right? Yes, very important. This one is risk management. Set a fixed percentage risk reward. Okay, risk per trade. Example 1%. Yes, we talked this in the risk management class, so you have to check out the video if you are not conversant with risk management. This one is what? Execute trade based on historical data. Based on historical data correct collection, that's where you are executing your trade, right? Because we have tested, so that okay, this has occurred repeatedly. So based on all those signals, all those conferences, you will know that you have confidence to execute the trade in future market or in your forward testing as well. So scroll back in time, high future price movement, identify valid trades, setups based on your strategy, that your strategy, price action, and what? Enter trade as if you were trading live, not cheating by looking ahead. Yeah. And then record entry, stop loss, take profit, and risk to reward. And now you're in the process of back testing. Very important. So track and analyze performance. This is what you need to pay attention to. The win rate of that strategy. Measure how often your strategy wins versus loss. So what is win rate? Win rate is okay, let's say you take, in a case of 10 trade, you took those 10 trade and maybe 5 were successful and 5 were not successful. What is your real win rate at that point? Is 50% win rate. So win rate is the percentage of your winning to your overall trade. Yes, so that is win rate. Next one is what? Average risk to reward. So as you also calculate your risk to your win rate, you also check all these trade. What was the average risk to reward in every day? Maybe it can be 2.5, which makes sense. And then you are building up a plan. And then draw down and recovery. Check the worst case scenario of this strategy. How is the losing streak like? And how is the winning streak like? When you put all of those together, you end up getting a good system. Yes, trust me. Alright, so common mistake to avoid in backtesting. Number one, looking at future price movement. Don't deceive yourself. Be focused. Do as if you are trading the real life market. Always hide future candles to ensure realistic result. Yes, very important. The second one is what? Don't force trade. Trade as if you are trading in a real life market. Don't see the setup and say, oh, this is snapper entry. It's because you are seeing the chart. Focus on your system and leave the rest. Right? Yes, very important. So the next one is what? Ignoring execution speed. Backtesting should mimic real-time decision making. So it should mimic real-time decision making. It will be as if you are trading live, not mimicking. Okay, sorry. It will be as if you are trading live, not trading because okay you have access to all what you are seeing. No, but you should be very serious about it because the way you trade on YouTube, that is how you trade in your live account as well. Yeah, so final note. What is the final note? A well backtested price action strategy. Pay attention to this now. Backtested, what you have learnt now, a well backtested price action strategy gives traders confidence and data driven proofs, right? Yes, that their methods works. It gives you the confidence that yes, this my method is working, right? Very important. The goal is what? Is consistency, not perfection. Please take note, the goal is consistency, not perfection. So with this I come to the end of this video. I congratulate you all for staying with me up to this time. Thank you, because I know you found value for this. From this, do well to destroy that subscribe button first. You smash the like button, and then you give a reaction and a comment of, you know a comment, if just in case you have any. Yeah, so thank you very much, and to enjoy the rest of your day while I see you in the next video. Thank you very much.